Welcome everyone to the Sophron Network, the podcast where you bring together professionals from the industry to get insights that you wouldn't get anywhere else. Today we're here with Amay Patel, who is also a member from the club back in the day. So we wanted to kick off our first in-person podcast with Amay as an OG member and also now running a hedge fund. We wanted to share more insights into crypto and also share more insights into running your own trading strategies and being a quant. My name is Vincent Brownsma, started Amsterdam Investment Club and then also Sophron. Sophron is the network for traders where we try to bring together people from all around the world to share their insights that you wouldn't sort of share on the internet in general. And we also want to try to connect people worldwide to just talk about their passion. And I'm here today with Arnav Sathe, the co-host. So Arnav, maybe you can also do a short intro.
Hi guys, my name is Arnav Sathe. I'm the founder of Prometheus Capital. It's a student-led investment fund out of the University of Amsterdam. We started a couple of years ago. Now we've worked with Vincent and AIC quite heavily, and through our friendship, we became co-hosts on Vincent's podcast. So we can meet cool people like Amay. And to give a short introduction to Amay, he is a partner and head of investments at Atomic Digital. Atomic Digital, a hedge fund he launched in 2025, which runs market-neutral strategies across OTC structured products, DeFi, quantitative, fixed income, and credit markets. It's also a flagship market-neutral fund, and it's offered in both USD and Bitcoin-denominated share classes. Before that, he was a quantitative developer at M1 Capital, building and optimizing systematic strategies for its liquid multi-strategy delta neutral fund. And before that, he has spent 5 years as an independent quant trader running liquid algorithmic strategies for clients from research and development through to live execution and portfolio management. He is also an alumni at the University of Amsterdam, where he studied finance and now splits his time between London and Dubai. So welcome, Amay.
Nice to meet you. Good to be back in Amsterdam, eh?
Yeah, welcome back. Because London, Dubai, and also being back in Amsterdam, like Amsterdam Investment Club.
Yeah.
Is it good to be back?
Yeah, it's nice. I mean, normally, half the year it's raining, so we get some sun finally.
Yeah, damn. I also miss the sun. But London is not much better, right?
Just always traveling. This year, Miami, Cairns.
Yeah, it's actually crazy because we wanted to sort of go over a bit of the difference between you started trading back in the day. I remember in university you would share all these crazy coins that you were trading, and I would be looking at them how did you find out about this coin? And also in general you went from trading your own strategies and doing everything by yourself to starting to work at M1 Capital, which is one of the largest hedge funds in crypto, right, in Amsterdam. Can you share a bit more about that transition and also how that difference, what are the differences between trading for yourself or trading for a professional hedge fund?
Yeah, so it started back in high school, 16 or so, 15, 16.
Mm-hmm.
Eventually got into as soon as I came to uni, I was old enough, I was over 18, so I was old enough to start making brokerage accounts and all. Started sort of trading my own funds there. Initially it was a bit of equities, but then I realized, in 2020, the COVID crash happened and I was like, okay, why not just buy crypto because it's so volatile.
Yeah.
It's always loved the volatility.
Crazy how crypto was back then, right, in 2020.
Yeah. So just, trading the volatility there. The market went up like crazy back then.
Yeah.
And then, 2020 had this crazy bull market and, everyone, you just throw a dart at anything, just go up 20x.
Yeah, because everything was going up, right?
Yeah.
I remember in the whole, in our community, everyone was sharing coins and the weirdest tokens and all these meme coins.
Yeah.
How was that at the fund when you started? Was that a big transition for you to sort of go from I can basically do whatever I want to working at a fund?
Yeah, so the time from when I started trading to when I was at a fund was almost 3 to 4 years at least. Mm-hmm. I guess anyone who starts trading isn't profitable for at least 2-3 years.
Yeah.
So I probably had the same case, but I just took it as just paying tuition to the market to learn.
How long were you? Like a couple of years, right? Like,
Yeah, like I'm sure I wasn't making money for like the first 5 years, so
yeah.
it took some time just to even break even.
Hmm.
And then after that, when I like the mandate of the fund, I was never running the strategy before, although I knew how it all worked.
Yeah.
I was sort of just still long, short, directional. I'll trade some options.
Hmm.
And then, like eventually DeFi came along.
Yeah.
So that's where there were just yields, like ridiculously outsized yields on chain. Like talking in terms of the thousands of percents annualized.
Yeah. And there's like smart ways to work with that, right?
Yeah,
Like,
yeah. Back then it was like, 30-50% annualized return was like pretty bad. So,
yeah.
it's a very different story now. But back
Yeah.
then, yeah, that was not what you're looking for. Um, but then of course I wasn't doing it with size, so that's a different story as well.
Yeah.
And then eventually you sort of learn all the ins and outs of that just by literally clicking buttons. You click some buttons, you lose money, and then you click others, and then you make money. Like, okay, now I know how it works.
Yeah.
And then a new thing lists, and then you read its documentation, and you're like, okay, this is interesting. So
Yeah.
you sort of get into the tech as well.
Yeah.
And I'd say it's very different to traditional markets, like especially some products, like for example, Pendle, where you can almost it's like stripping a bond and you're just trading the underlying yield. Or like it's second derivative of like Boros, where you can literally speculate on funding rates. Like you
Yeah.
throw a funding rate and like lock that in, which is quite ridiculous as well.
Yeah. You mean in terms of like, is it like, are these kind of things like easy to find because the market is still a bit inefficient, or are those like sort of things that only the smart people find, but like for the smart people, it's quite easy to.
Well, I guess everyone comes across it, right? It's not too hard to come across. It's more just like how can you take advantage of it and sort of
Yeah.
exploit it and see where the inefficiencies are and then capture them the best.
Yeah.
But then like that's when you're just trading as sort of retail, right? Then when you come into a fund, you've got to do it with size. So
Yeah.
there might be many, many inefficiencies, but if it's only gonna do a few hundred to a few $1,000s, it's very different to when you've got to put almost 7 to 8 figures and try to find trades that can take those kind
Yeah.
of capacities. So that's sort of the variety of stuff and like the kind of different things you have to look at.
Yeah.
And then of course you've got to look at the risk, so counterparty risk, insurance, because it's like the stakes are much higher. And then that my transition from like retail sort of trading to M1 was more just I had a friend who worked at one of the partners at M1. He worked with him,
Yeah.
so he was like, "Oh, why don't you apply there?" And I was like, "Okay, I'll apply there." Yeah, and then I ended up joining. I was the first employee there, so in for a fund. They were really
Yeah.
small back then. I
How
think.
many people were there? Like,
It
when
was
you
just the
started?
partners, so
Yeah.
it's 4 of them, 4 or 5 of them, and then it was me.
Wow.
And they had about 10 mil AUM, so they were really
Yeah.
small. And I think almost when I left, they were like 150 in like a year or so.
It's super quick how like
Yeah.
it got traction, right?
Yeah.
Like, and it was completely delta neutral, right?
Yeah, so I mean, their mandate was market neutral, but the portfolio was pretty much all delta neutral, and the strategies have also really developed like over time. So like there was a lot of quant strategies initially, and then they went more into like TVL deals and that kind of stuff. And I'd never really done that stuff before in retail, right? It was more like you would go do deals, you'd sort of, provide liquidity to a protocol, you might trade a protocol, they give you extra
Yeah.
tokens, they give you extra terms, low mint fees, low burn fees, you got to then price that in,
Yeah.
and then you also got to factor in counterparty risk, the volatility of what you're doing. So there's a lot more things that go into it, and then you end up reading contracts and stuff, and you're like, okay, I'm good at the investment, but then
Yeah.
I've got to now understand like, okay, where's your counterparty base? What jurisdiction is it in? If they default, do you have senior creditor claims on them? Like these kind of things, right? So you've got to sort of learn a lot of legal stuff as well.
Yeah.
Especially if you're one of the first employees at like a fund, for example.
Yeah. So you were
You
doing
learn-
like everything.
You do everything.
Yeah.
So you learn a bit of legal stuff in sort of the institutional trading, like ISDAs, like those kind of contracts, MLA contracts and stuff. You learn stuff like investor relations, how to sort of raise money.
Yeah.
Like if you were to sort of raise money as a fund, you're not really sitting there doing a sales pitch. It's more just showing the investor how low risk you are and then trying to give them confidence into your strategy, show how like you can diversify. Because if it's, for example, if it's a fund of fund, how you could show that you'd be a great diversification in their portfolio. Because at the end of the day, they're just sort of mapping out each of their allocation and trying to diversify across their strategies and stuff. So you've got to sort of show like how you're different from the competitors. Otherwise, in terms of returns, like a lot of the funds, like for example in DeFi or market neutral, the returns are quite similar. I think what really sets them apart is more the capital efficiency, how quick you can move collateral, what kind of prime broker access you have, how you can margin things. So it's like, for example, two different funds that are running the same signals or the same trades might be having a system where one might just be looping something, but the difference is made where can one borrow USDC at 3% versus the other guy borrowing at 7%.
And that those are mostly like deals that you negotiate, or is that
so it's a bit of networking, it's a bit of other stuff, but it's stuff like going back to it, it's like one might be borrowing USDC at 7%, one might be borrowing at 4%, one might have access to prime broker margining where they have soft liquidation, so they can use much higher LTV. One might be able to post margin order like in an automated way. One might so like these kind of things really make the difference, and then they might be running other strategies as well. And you might be able to cross margin different stuff together. So like.
So it's really like more like also not only looking at your strategies and like building strategies like the whole day, because that's like usually like, I don't know about you, Arnav, but like if I think about a quant, I would say like these guys are only looking at like trades, right, and strategies.
Like when we look at order books, it's mainly from a mechanical perspective and how we can find the inefficiencies that you were previously mentioning in the market, but through just a lot of back testing and then trying to inculcate those findings into the existing models, or then completely scrapping the current model and then building from scratch. But one more thing I did want to ask you was, when you started learning these institutional sort of mechanics, where you said it went from looking at not just like now instead of going from retail into trading in size, you had to figure out like order book mechanics, you had to figure out the legal stuff. How did you like parry the tide with that? What, like the learning curve, was it sort of something that just clicked with you because you were so interested, or was it just, as you said before, just clicking buttons and figuring it out?
No, so with that, I didn't really have there wasn't much room for error, so I really had to be right. And I luckily had colleagues that had background in law and like had been running. Like my previous colleague Stephen, like he was at Theta Capital, so he had been doing all these all the time. So sort of just learning from him how he would structure deals, how he would sort of approach different things. And like what would typically happen, he would give maybe a contract to me, or they'll say like, "Oh, what are your thoughts on this?" And I'd sort of do my own research. I didn't have much legal knowledge, but I could always ask GPT to sort of help me out if I need anything. I of course wouldn't rely on it, but just general guidance on what to look for and what not. And then at the end of the day, it also comes down to common sense, right? It's like if there's like, if you're dealing with some strange jurisdiction, or so maybe the contract has one entity in, I don't know, like Cayman and the other in the UK, and then if there's a court order or like there's a contract dispute, you're going to settle it in Singapore. Like that really becomes tricky because you've got like multiple different entities. Like that's really just common sense. So those kind of things, but then the underlying nuanced stuff that gets a bit more harder, and that's sort of you have to learn over time.
Everything is moving so quick. Do you sometimes have like moments where everyone was sort of trying to figure out like how to deal with something, and then you would go up to anyone in the fund or in the industry and would be like, oh, I kind of want to know how this works, but then it would be so new, everyone was trying to figure it out? Or
so there was many sort of cases like this. One would be like, for example, the whole Solana, like when there was just a bunch of trading on that in terms of like meme coins and God knows what, like the whole kind of strategies, people were like sandwiching, people were LPing, people were those strategies had existed before, but it's stuff that everyone was trying to figure out. another example is like when Boros launched, which is like where you can literally trade funding rates. That's sort of a new concept altogether. Same with Pendle, like the launch of Pendle. People were trying to figure out like, you could literally short yield and long yield, which is incredible because like let's say for example in the TradFi world, say you had a stock and then that stock was promised like I don't know a 5% dividend annually.
Yeah.
You could sort of hedge out the risk of them changing that plan to 3%.
Yeah, but in stocks it would be like if they were to pay it in like stock itself, right?
Yeah.
Like if they were to like, because that's how like usually the yields are paid out, right?
Yeah.
In like a special token
Yeah.
that like has risk, right?
No, it could be paid out in anything. So it could be paid out in USD, it could be paid out in euros, it could be paid out in tokens.
Yeah.
But it's effectively like let's say there was Amazon, for example, and let's say, for example, Amazon said they're going to pay 5% like annual stock dividend. What you could do in a product like Pendle is you could short that. So you could say, I'm just going to lock in the 5% and I'm happy with it. Now, you would have an expiration on the market. Like, for example, let's say it's 3 years out. I mean, it's these markets are very short duration, but let's say it was 3 years out.
Yeah.
Now you sort of, if Amazon says, no, we're just going to pay a 3% dividend, well, then you've sort of locked in that 5%. So you've effectively just hedged the dividend rate there.
Yeah.
And
So
because
you can always play with it to like almost take away all of the risk.
Yeah.
Right?
So you can effectively take all that risk away. And especially in DeFi, so many people are saying, okay, there's points here, there's tokens here, there's like yield here, and like the sort of uncertainty and the sort of range on what those yields could be varies huge. So like it really also depends on sort of how big it grows. So you're really speculating on, will this project grow huge? And if it grows huge, well, then it'll launch at a much higher valuation. So the points are worth a lot more. And what this product, like for example, Pendle allows you to do is it would say, look, I know that there's such a huge uncertainty, but if I think like it's priced at a level that I'm comfortable at, I can sort of just lock it in.
Yeah.
And then you can also leverage that as well. So you could post like it's almost like I would say a zero coupon bond. You could post that as margin, which is like the payment is just the points that you've locked in. So you're buying like $1.90.
Yeah.
And then you could post that as collateral and then loop it. And sort of what you see on chain is that the kind of credit rates are ridiculously low. So you can literally borrow at like 3 to 5% on some stuff, which you're never going to get anywhere.
Yeah. Why is that? Is it because it's like more like appealing, or do they want to attract like people who would take that, or like what is the sort of reason behind it?
Well, it's sort of, I think a big chunk of it is just borrow and supply. Second thing is sort of incentivization. So a lot of people are launching their own stable coins. For example, Ripple, they're incentivizing right now. Athena did as well.
So you have those short windows in which you get really good rates.
That's that. And then also some are like DeFi and crypto only funds. So they can't lend in traditional markets. And because they might be having such big balance sheets that they actually need to lend. And if there's not enough borrowers, they're just reducing the rate so that they can have much more demand. It's much rather like you'd have your balance sheet utilized and not utilized, right? So
now, Amay, we've talked a bit about your background. We've talked about how you've interacted with the market, going from retail and then working at M1. But we wanted to talk a bit more about your fund and now your current expertise. So Atomic Digital runs market neutral strategies across several different areas, right? So OTC structured products, DeFi, quant, fixed income, and credit. Most young funds generally tend to pick one lane. Why multi-strategy from day one? Like how do those like sleeves actually complement each other? Did you actually want to do multi-strategy, or was it something that was just a product of your making from your previous work experiences?
So multi-strategy is a bit of all, and there's a bit of thought behind it as well. One is that given that the market moves so often and the regime changes so often, there's huge amounts of alpha decay. And also the second thing is that diversification I find it to be incredibly difficult if you're just simply picking different tokens and then holding them, because as volatility increases, the beta also increases and the correlation also increases.
Yeah.
And like at the end of the day, you're almost just like taking a leverage position in the market to some extent. Like, of course, there are ways to prevent that, but what our sort of goal was, look, why don't we just try and deliver somewhere in the range of like 15 to maybe 25 in a good year percent annually, and then have it at like a 5 sharp ratio. Like the goal is about 3 to 5 sharp ratio, and then have like a max drawdown of maybe 1% worst case.
Yeah.
So we thought like there's going to be a much bigger demand for those kind of products on the institutional side, as they prefer to have much lower drawdowns and much lower volatility. So then we thought, like, what kind of strategies can get to that? Of course, there's delta neutral, which is just simply a bit of the stuff I was doing before. The kind of stuff that I sort of was good at from before and I sort of liked doing and wanted to get into it more was more of the locked token stuff.
Okay.
So like OTC structured product deals, a lot of maybe lending as well. So like structured lending. So this would be against, I don't know, say someone's doing, like, for example, say someone's doing a locked token trade, they might have a delta neutral hedge position and you could lend at a much higher rate against that.
Yeah.
As long as you can liquidate it, and it gets a bit complex there. And then we also do some like DeFi and some quant stuff. So I built some quant stuff over the past years in my bedroom. Couldn't really use them at my old fund, but then I was like, why don't we just build them in? And then my ex-colleague, well, my current colleague, Amir, at his ex sort of job, he used to build quant strategies. So we had a bunch of them, and we thought that, look, if we build a multi-strat quant portfolio, we can sort of have each different one with a sort of inverse or a different correlation to each other, a low correlation to each other, and they would sort of cancel out the risk. So we thought it would be a great sort of part of the fund to add. So right now the fund does like OTC structured products. We do, I'd say, a lot of TVL deals. So this would sort of be, you know, the contractual stuff I was saying before, where you sort of provide liquidity and have extra private incentives.
Sure.
And then, you know, where we've got a little quant sleeve, so it's about 10% of the fund now. But because if you scale up there, you know, the volatility increases. But the return's still quite high. And then we do some lending. So like simple lending, we do some DeFi stuff as well, as I mentioned earlier. Like with the yield trading. I'd say my main sort of edge and focus is on the locked tokens, just because a lot of it comes down to just networking and who you know, what kind of foundations who are able to sell you stuff, like the kind of brokers, the VC funds. Like there's a huge market for it. And it solves sort of a big issue in the general market where like early investors want to sell their positions. OTC desks might want to also sell their positions. Foundations need to raise capital, so we would help that as well. And then we're a fund and we're able to take on those positions. So really like everyone wins in this scenario.
True.
And then, you know, as you're hedging, you're also providing like flow to OCC desks. So like it helps their business as well. So like there's quite a big sort of network effect in trading here. It gets really nuanced in the kind of stuff you have to do. Like it's very easy to mess up, and there's a lot of stuff you've got to look at. Like, for example, who controls supply of these tokens, the vesting, how big the unlock is. Like if I'm buying from a foundation, it might be a private round, that's okay. But then if you check when their seed investors or their early investors are unlocking, and if you're unlocking the same day, well, then you've just got a big amount of the market just like, you know, selling at once. So you've got to factor that into pricing. You've got to factor in the liquidity, who the market makers are, how long the market making contracts are. So if there's liquidity today, but I vest in 6 months, will there be liquidity in 6 months? So you gotta sort of know if there's a market maker that has contracts in 6 months. So you've really got to do a lot of research. It's almost as if like you work for intelligence and you're putting pieces of the puzzle together.
Crypto must be quite tough, no? Because all these founders and foundations, and especially the early ones, they're quite private, right?
They're quite private. They don't like sort of their flow being known. You've also got to be careful to respect that as well.
Of course. But one more thing I wanted to ask you was with, because I was speaking to some of my colleagues and counterparties that work out in London, right? And these are some of the most hyper-aware individuals I've ever met. They're in the TradFi space.
Yeah.
But with multi-strategy and TradFi, I can see how much discipline they require. To the point where they're working on some of the structured deals from the funds that you were sort of discussing before, and then normal like equity names and their own books, et cetera, right? But then for you, what is there something that you don't like doing? That some of the deals or some of the coverages that you have that you somehow, or you prefer to work on something that's more geared towards your interests, or is it something that you just constantly have to do now that you're a multi-strategy fund?
Yeah, it's a good question. I'd say what I don't like doing is just going through contracts all day. Like, I prefer to sit there, and I don't mind sitting on an Excel spreadsheet and really just pricing a bunch of numbers together and seeing what I can come up with.
Yeah.
But then when it comes to the legal work, and it's like, you sort of still, it has to be done.
Yeah.
That sort of, I prefer not to do that. But of course, it's nice negotiating. So when we have a deal, and for example, someone might come with a TVL deal and they might say, look, we'll give you 3% in US dollars and another 18% in tokens if we launch at this valuation, which, we have to then take the risk if they do that or not, right?
Yeah.
And then I can go and tell them, like, look, we're going to buy, then I have to go tell them, like, we're going to buy insurance, we got to take this risk. You're small, we're helping you out. You make a compensation, like have a guaranteed yield here. If you default, can we have extra sort of incentives or rebates and that kind of stuff.
Yeah.
So, work on these, it's sort of, you get better at it the more you do it in terms of negotiating.
Is it also like at one point you build up a certain reputation, right? Probably with the fund, and then also do you have is it more, do you see that the better deals are the ones that you reach out to or the ones that come to you? Because usually they say being proactive is very good.
Yeah.
Or is it at a certain size that a lot of projects and such come to you and want to sell to you?
Yeah. It's sort of a bit of game theory as well. So, if I'm one of the early ones who are going to do the deal, I'll have the highest bargaining power because otherwise if it's sold to 10, 15 people and they're doing it, if I ask for really customized terms, they're going to be like, look, we've already had 10 investors, and if we give them a worse deal than you, then they're going to complain. So, but if you're one of the first ones, then it's much better. So that's one thing. You sort of want to keep warm relationships going with them, and then see okay, if they're going to launch one, well, if you're one of the first to receive it. The second thing is if you actually help and try to create the deal itself. So if you say, look, I think you've got a nice project running, I think I could help raise some liquidity for you if you run an incentive program, and we can work on pricing it together.
That makes sense.
And once you do that, they'll might be much more open to giving you preferential terms because you've sort of helped them create it and then help lead the whole thing. It's like
that must be so much work, right? A small team and such. It must be quite tough to balance all of those things, right? Because where should you as a quant or chief investment officer, where should most of your attention be? Let's say you strip out all the contracts going through and all of that stuff. What's your most important sort of thing that you do where the actual return comes out of for investors?
I'd say more on just the negotiation of the actual deal. There've been times where I've turned a really, really bad one into one of the best ones. And I think if you can understand that maybe the underlying trade is very low risk, you can really push it a lot. For example, we did one where we're lending US dollars against T-bills. And then that was fundamental trades, right? But then we got that to 22% annualized paid in USDC guaranteed. So
that's actually very good.
So we turned that into
hey, Warren Buffett, if you're watching this.
Exactly.
That was, they came with look, we'll give you 3% in the underlying T-bill rate, and then just give you a bunch of tokens, and we're look, we can do more size, we can hedge off doing more size with buying insurance in the underlying smart contract and that kind of stuff, and make sure that it's properly backed and do a better due diligence, and then if we do more size, it's going to give you preferential terms and then turn that yield into USDC. So,
and then once you take a deal on, and you get like, for example, certain tokens that unlock, like, is that like a constant hedging process that you have to like manage?
Yeah, so we try best not to have tokens at all.
Okay.
And then if we do, we would say we want a minimum guaranteed valuation of them.
Okay.
One is so that we can actually price it on the books. Otherwise, if it's in the air, it's really hard to price, and then you don't overprice it,
like,
and then
just out
when
there,
you get them, it's much lower. Yeah, so that's one of them. And then there's the other risk where they actually don't launch a token or something at all, and then you're in trouble again. So you want a compensation for that not happening. So it's really nuanced things here and there.
But now, when you're talking about it from a risk perspective, are there some deals that you like really, really like and are willing to take on more risk onto your books? Or is it always that you sort of carry like a parity in the discipline when you look at deals, even if you know like, oh, this could make me a lot of money, but given my current situation, I think it's just safer to sort of play a more like realistic and conservative goal rather than being aggressive into deals?
Yeah. So that's really important. I mean, sort of had to learn that over time.
Okay.
So like, it'd be really tempting to put in something when you've got ridiculous returns, but then you really got to understand the risks as well. What I like to do is just understand the fundamental trade that's going on and prefer the super, super simple stuff like over collateralized lending, like lending against T-bills, running a basis trade, like, Athena and that kind of stuff. So those are the sort of stuff I prefer. And then you've got more complicated ones, like one came across where they were like buying Turkish bonds and then buying forwards on it to hedge that off. Like, it's a great trade. I think like the Turkish bonds are trading at 40% annualized or something, and then you can hedge the default. And the credit default swap trades are like 2.6% annualized, something like that. And then you'd buy a forward, and the forward would be a bit expensive, but then I think you net like 14% delta neutral, but then like your risks are one, Turkey defaulting.
Yeah.
Unlikely Turkey would default on lira bonds, but like on USDC bonds, there's a chance of them defaulting.
Yeah.
The second thing is if you get debanked in Turkey, like I don't know who I'd call. Like say the bank.
Do you speak Turkish now? I saw you speak a bit of Spanish, right?
Oh yeah, I know Spanish, just Turkish.
Okay.
Yeah, that's a learning curve.
I think it's a good trade. Like if you want to do it on your own money, but on a fund now and not touch it.
Yeah.
But it's like because there's just a lot of regulatory risk there. Like what if the prime broker just says no, we're closing a forward, and you're just unhedged. You just
Yeah. No, so then you also don't like put too much into like those kind of trades, right? Because it's just, it's like even if the odds are low, like you don't want to risk like blowing up a whole fund because like Turkey defaulting or like if anything, like you don't want that risk. Like I don't.
No, and then one more thing I wanted to just touch up on before we go to the list of questions that we've sent to you, so you kind of have like a backbone to talk to us. But like
Turkey was not in there.
Yeah, Turkey was not in there.
Like someone at Turkey and like ask you about Paraguay and like
we'll ask you about all the gray zones basically. But one more thing I wanted to back you up is now for any of the young fund managers that are watching, you're sort of like at the cusp of being sort of young, but also really experienced and have like a very aware understanding of how the mechanics of not just working in an existing institution, but also setting up your own and growing it into what it is today. You were talking a lot about warm relationships with the people that you work with and the people that you do deals with. But does it only sort of like stop at the people that you're doing deals with, or do you think that warm relationships should happen with every counterparty that you sort of come across and like build a relationship with over time?
I think with everyone is quite important. Like there's some that you sort of want to prioritize over others because they're like you're almost trading with them every day. And that's sort of why I've been traveling a lot. Like there've been a lot of conferences and stuff around the world in the past year, like Cairns, Miami. We're going to go to Singapore this year as well. And like the kind of people you meet there, are like the people you're texting and chatting with every day on text. But when you go and meet them, you actually sort of learn about what their hobbies are. It's like, do they play tennis? Maybe they play golf. Maybe they like surfing and that kind of stuff. Sort of learn about them as a person as well, which is pretty hard to do if it's on like a work call. You're just discussing work stuff.
Hey, do you play tennis?
Yeah,
that's
it's like we're not going to really have a Google Meets call to just say, okay, let's talk about how your tennis game was.
Because crypto is very like separated and decentralized, right? Like actually also the people working for it, right?
Yeah,
like, you have people like all around the world.
Everyone's all around the world, and it's really nice to sort of see them outside the work environment.
Yeah.
So you sort of want to build relationships on that side as well. Just sort of learn about them as a person, like what their hobbies are, apart from what the kind of work they do.
And then you get a better deal after, so it's also nice.
Do you ever go out for like I don't know, a couple of games or a couple of holes on golf, or do you ever a couple of sets of tennis with your clients?
He's a great golfer, I know. Like, always
very
like
nice.
Yeah, so I mean,
nice.
Free weekend. I have another friend. He runs a VC fund. So, I mean, we don't do business together, but he's also the same age as me, and he's also Aussie. So he's like we play golf together. It's good fun. There's like a paddle league in London going on.
Oh, very nice.
There's tennis as well. So.
How is London just in general, like compared to Amsterdam in terms of, because there must be like so many funds, and how's the crypto space also there? Because like Amsterdam has quite a lot of funds. How's London just in general, like vibe and people and
London's very big. Like you can almost meet anyone you need to meet there.
Yeah.
Also a lot to do, but with London, it's like I'd say it's a much bigger crowd than in crypto than it is over here.
Yeah. More market makers, right? Like the
like the big OTC desks, the big market makers, big exchanges. They're all based there. But then, like within the Amsterdam crowd, like all the big funds, like you're very well connected. So it's a smaller community. It's still like the guys are still running huge operations, but probably I'm a lot more connected here than I am in London for sure.
Yeah. Because it's probably more like tight knit here, and you can like sort of have a conversation with almost anybody if you're working in the same space as them. They're also quite I'd imagine they're more like I say friendly to having a conversation with just somebody who's working in the same field, right?
Yeah.
And might also be nice, like sort of bridge, because like you started with like first Amsterdam a lot, and you like moved to London because like you started Atomic Digital. With how many people was that?
2 others.
Yeah, and like you were seeded with like 10 mil like internally, and like now you're like scaling up, right, with like external investors. Is that something where you see like, okay, like it really changes when you bring on board like investors in the fund, and also in terms of the strategies that you manage? Do you start to like change that approach, or is it because you also said something where you were like, oh yeah, we tailored the strategies a bit more to the appetite of like institutional investors?
Yeah.
Is that something that you kind of keep doing, or do you once like have your strategy and then you just like keep doing that for like a long time, or does that change based on like the
so I think like the underlying strategy of just market neutral funds is sort of the same in terms of the mandates. What we try to do is sort of tailor it a bit to our investors, just in terms of the liquidity we keep. Like our monthly sort of liquidity is monthly, so you've got monthly subscription and redemption. So that means like we've still got to keep a big chunk of the fund liquid just in case there's a redemption. So like a VC fund where you just lock for 7 years, so we could just put it in a long-term TVL deal.
What is the reason that it's like so short? Because like crypto goes in cycles, right? So you don't like maybe people will like withdraw when you actually have like good deals coming up, right?
So. Well, we sort of like to keep it easy for the investors, and I think if we can manage it, it's great. All of the other funds that are running the same mandate, they have sort of monthly liquidity, so it's quite nice. Because fund of funds, they like to rotate a lot, so it sort of turns them away when you've got like quarterly, like biannually liquidity, and if they can only subscribe and redeem like every half a year, and like let's say in March they want to write a ticket, well now they've just got to wait another 3 months. So
No, that makes sense.
Fair. And then, but does that ever become a bit annoying for you, or is it always that you guys, when you look at the sort of transient transactions when it comes from these ticket sizes that are rotating quite frequently? Because he said like crypto, it goes in cycles. But does that ever like hinder any of your current positions, or has it in the past where you've been like, come on guys, like this is,
Yeah, well, it's a good problem to have, I guess, when you have a lot of inflow. What the tricky stuff is just allocating.
Yeah.
Like now we're quite small, so we're definitely going to hire us after like a few months or in the near future.
Yeah.
But like let's say for example you have a 2 mil fund and someone puts 10 million in the fund.
Yeah.
Like that 10 million might come on the first of the month, and then within the next 10 days you actually deploy that money. So then if you've got
much pressure, I see.
Yeah.
Like, yeah.
Yeah, and then if you've just got another 20 days in the month to actually have returns on that, and then the next month more comes in, then you've got 10 days to deploy it. So you've got to now, like learning from that, like we had that once on I think it was one of the early months where we just had almost 10 million coming in 1 month, and then like the fund was still small, and I was like, okay, this is a lot of money. What do I put? So then, I was just calls all day, okay, trying to make deals, and you kind of really push. But then I realized that why don't I just make all the deals before the month starts? Ask them for extra capacity. So say like, I'm going to give you maybe 3 million now.
Yeah.
Give me extra allocation of 5 million as flex capital. So if I want to add to the deal of 3 million, I could add another 5 million.
So you're
at the same terms. You're pre-planning.
Yeah.
And I don't have any binding commitment to it. So it's like,
And then you text your investor, like, would you be interested to like deploy a bit more or something?
No, we wouldn't do that. But then if there was a big inflow, we had nowhere to put it because, we'd still like, if you had, for example, 5 deals and you wanted to put maybe 20% of the fund in those 5 deals, well now, if the fund increases, well now I can just still pro rata allocate to that. And I don't need to go and make any more negotiations because...
And they don't care that, like, for example, you say, can I have 2 mil extra? And then like you don't allocate afterwards?
Yeah, like that's fine. Like we don't have a binding agreement, and we tell them like, look, say where we want to allocate more, can you give us the same terms later on pro rata? And they're like, yeah, sure. And then...
That's actually really nice.
Yeah. That also makes think that he's very confident in the deal that he's making too, right? I guess from a negotiation perspective, I see it's pretty good game theory.
Yeah. So then
actually that makes sense.
Yeah. Then that money is making money the entire month. So it's not just you're not spending the first 10 days trying to find a deal.
And what's like, because like how resistant is, because like crypto is such like cycle based market. What is sort of the like the biggest kind of risk? Is it like no deals in the market, or like how do you sort of look at like those like cycles and with investors? And
so I think the biggest risk is poor sentiment and then low liquidity. Like low liquidity is just the worst because nobody does well there, and the lenders don't do well, the borrowers don't do well. There's much less deals, the sizes are much smaller, and you really got to allocate. So the yields are super compressed. Like that's what we're actually seeing right now. It's like a really, really tricky market. That's sort of the biggest stuff.
Okay.
What we try to see is and try to focus on is more like real world assets. So like tokenized off-chain assets that have still got high consistent yields. And on-chain, if there's low liquidity or like low borrow demand, the rates are going to be lower. So if we can borrow at significantly lower rates on-chain, and we can like maybe loop something that's got significantly higher rates from yield off-chain with actual returns. I mean, of course, you've got to do extensive DD on it because it's not all like on-chain, like it's not fully accountable. It's not like verified. So you've really got to check, but there's a huge arbitrage in that, and then sort of the returns are a lot higher on those kind of stuff.
Must be also like quite tough to constantly like look at the market and then evaluate like, do I want to do this deal, or like am I not gonna do any deals like this month, right? Or like do less. It's like,
but we've still got to deliver returns. So you don't have an option.
Investors, man.
You want to find high capacity stuff. That's the goal. Like stuff that I could stick large size in.
But there's actually a lot of like, if you look at it now, like at the events and like a lot of the traditional parties are talking about like stable coins, real world assets. Like, so there's a lot of like talks now, like in Paris, the blockchain week, there's so much going on. Like, why are the markets now like a bit like down in terms of deals? Because you would assume that there's a lot of like institutional adoption happening, no? Like
like I'm very bullish on DeFi. In general. Institutional adoption is just like in cycles, really. It's like when there's a lot of hype, a lot of it will come and then they'll go. The thing is where like it's our mandate to just stay in DeFi. So You know,
Yeah,
you
yeah.
got to find ways regardless, right?
Sure.
Yeah, and it's also like at one point, like a lot of assets are also coming like on chain, right? So
Yeah.
then it's also something where like, do you see like is that a huge gap or like for you if you were to move from like traditional like or from like DeFi to more traditional markets, is that like same quant principles?
No, it'd be very different.
Yeah.
Like I think I would struggle, and if I was to run an equity fund.
Yeah, it's really
So,
different.
like, but you're saying that you'd be more like you're comfortable in the current environment, even with the
Yeah, it's tough, but I think like year to date it's something like 6%. So I think we're like 17% annualized, something like that.
Yeah, I mean that's not bad.
Yeah.
But one thing that I wanted to like sort of piggyback off of now
Yeah.
was that you've not traded for a full cycle.
Yeah.
Like, can you name a strategy or edge that worked well 2 years ago, but now is gone, and one that is emerging that most people are not yet paying attention to because
Yeah,
you
but
sort of
without giving away like
yeah,
your-
without giving away your prop book, you know what I mean? Like, but
Yeah,
just
but
something that in the past that like you maybe have piggybacked on something that you saw that
Yeah,
a lot of people
yeah.
were doing, for
So,
example.
so it's more just being early to a product. Like
Okay.
I mentioned earlier in this interview, like Pendle, like
Yeah.
you could trade Athena, the PTs there, like 30% annualized, and the borrow rates on that were like 5. So the spread was like 25% a loop annualized return, and you could like leverage that up 5x, and it's effectively just the basis trade back
Yeah.
then.
Yeah.
So that trade was ridiculously high yield. Then everyone caught on to it, and now like the spread is like 1%. So you're like you loop it a few times, maybe 5, 6, 7%. So that's one trade that worked really well, just yield trading.
Yeah.
And like being able to price yields. If you can do that well, like it's an incredible good skill to have.
Yeah.
And I think in the future, probably like just RWAs and cheap on-chain borrow rates, like being able to borrow dollars at 2-3%, which is literally the T-bill yield,
Yeah.
and then margin that with like RWAs or like private credit.
Yeah.
Yeah.
That's giving you 8 or 9%.
Yeah.
That's probably a very high capacity sustainable trade, but of course there's risk to it, so you've got to fully understand them.
Exactly.
So what's the thing there? Like, do you think they will eventually become like as efficient as like the current like traditional markets where you have a bunch of market makers in the space, funds, like people actively like looking at the markets? Do you think that will become the next move for like DeFi? Or
Yeah, I think so. I think a lot of it is just regulatory one, like
Yeah.
trading these really exotic products.
Yeah.
It's a bit hard for a lot of US funds and so on to do that.
Yeah.
Second is sort of understanding a lot of this because it took me years to sort of figure out everything.
Yeah.
And it's a lot to sort of digest as well. The third one is sort of the capital efficiency you can get. It's very different in the traditional world. Like
Yeah. Of course.
I could be running one strategy somewhere and having it cross margin with something completely different,
Exactly.
and I could source out with like borrow rates at really low rates. So really, two people running the same strategy could have like 50% different returns almost just because of the way they margin, the rates they can get, and sort of the deals they can sort out in between.
Yeah.
Yeah.
But with the like sort of talking about capital efficiency, what would you say like with the current investors that you have or people that you make deals with, are they more like hawkish? What's their sentiment look like in the DeFi space? Are they like very conservative in terms of the estimates that they create because of like liquidity issues or in DeFi and specifically with crypto-based assets, for example?
Yeah, it's a wide range. Like we have some investors that are like completely bearish on the whole environment. But then I mean they're still just willing to take the risk in case things turn over.
Yeah.
Some are super bullish. The ones that are like crypto only fund of funds or just native, I mean they sort of have to be bullish because that's sort of their job and it's the mandate.
Yeah.
But it's sort of a wide range. I'd say in general people are quite bullish. Just now, like I've seen a few cycles now, and this is just low liquidity is just one thing that just keeps popping up, but it gets better.
Yeah.
Yeah,
for sure.
Because now you also have a lot of market makers, right, in the market. We're still like quoting and or like we wrap things up. I want to ask like few like sort of rapid fire questions where I was just wondering like what are your sort of best moments also when you were trading like back in the day?
Yeah.
What was like some of those best kind of moments? Do you have any?
Um, Probably like learning what airdrops were. So
Oh yeah, yeah.
I think that was pretty crazy. Where just
Is that still a thing now?
yeah. So like there've been stuff where you'd like click two buttons and then you get an airdrop of like a few thousand. So I've just like literally clicks a sign or put zero initial risk and you just get an airdrop for just signing a
That's
transaction.
crazy.
Do airdrops still work on sizes that you trade on?
Yeah.
Okay.
It's just like pro rata, right? So
Yeah.
Once it like I think like on optimism, I contributed to optimism by filling out a questionnaire on what kind of investor I was, and I got
Yeah.
$800 for just like filling out the questionnaire for 5 minutes.
yeah,
And it's
yeah. Like
Yeah.
they're not actually selling underlying security. It's just printing a token, and then the market has a value of it, and that's why it exists, right?
it was like 20, when was that, 2020 or so? It was
Yeah.
kind of crazy. Like the whole group chat was like going wild for crypto in general.
But it's crazy. Like I also used to work as like I used to work in a kitchen like when I was like a few years ago, and I'd just have one airdrop, and that'd be like my monthly salary for buttons.
It's actually ridiculous. Imagine like you're in like a professional investor and like you get an Nvidia stock airdrop.
Yeah, that'd be
Because
insane.
it's literally like you filled out a questionnaire like, do you like the CEO of Nvidia? Yes. You get an airdrop.
Yeah, and it's like you're just sitting with like 1K of stock. That's like normal in crypto. And
Yeah.
it's just for me, like, going to any other market would just be weird because, these things don't happen.
Yeah.
There've been people that have got like, 8 figures of airdrop for just like doing a few things here and there.
That's insane.
Pretty good.
And also like London or Dubai.
I prefer London. I mean,
Yeah.
sort of grew up in Sydney. It's a lot similar.
Yeah.
Okay.
Dubai, it's like I like to play a lot of sports outdoors, so it's really
Yeah.
hard in the heat.
Yeah.
Traffic's not great.
And for work, like funds and such.
I know Dubai does. I haven't really done a lot of work there.
Yeah.
For London, there's quite a bit. I've got quite a few friends.
Yeah.
It's quite a big hustle culture there.
Yeah.
A lot more than what I found in Amsterdam, I think.
The one risk most crypto funds quietly underprice.
It's a good question. Liquidity risk.
Okay.
Yeah.
Yeah.
Like that can really screw you over.
Yeah.
Yeah.
Like being stuck in markets, paying high interest rates if there's no liquidity. Buying locked tokens where liquidity dries up, or
Yeah.
Can you pre-plan that? Right.
you can. There's a few tricks you can do. You can like maybe use token settled derivatives. So you're not the one selling it at the end of the day.
Yeah.
You don't want to like pre-commit and then if they back out, you've got an issue. But you would sort of structure it as flex capital, where I have maybe like what I try to do is keep another like almost 50-40% of the fund. Is
Okay.
if I go that much next month, I know where to put it.
Yeah, that makes
That would
sense.
be an issue.
Yeah.
Yeah.
Otherwise, you don't want to be spending time working trying to find a place to put it, and then
Yeah,
just
because
making
like let's say
yield.
and you find a deal already, like you've done the DD, so
Yeah.
it's not extra effort to ask for more capacity.
Yeah.
Yeah. But then you need to like I feel like would you have thought about that? I think that was a super interesting like insight, no?
Yeah. No, I wouldn't have thought about that.
No. So I never pre-plan anything. So that's why I didn't even pre-plan this podcast. So
We just texted you and you were like, "Yeah, I'm done. Why not?" So there was no planning. We bought these mics today, actually.
yeah.
But one more thing, from like a personal perspective, like how do you balance it all now? Because you're still
Yeah.
like in your 20s.
Yeah, I'm 24.
Yeah, you're
I'm
24.
sort of me, like running the whole investment side, and I've
Yeah,
got men to help
insane.
me as well.
Yeah.
Yeah.
And like it's almost like almost 50 million now. So
Do you work 24/7?
I don't think about it.
Like 16,
yeah.
7?
Well, I think one of our biggest edges is just always being online. Like I'm always on my phone. So when
Yeah.
you text me, I'll always respond. Like
Consider
Like
you also
this,
have like a
yeah.
digital watch, right? So you
yeah, I
can
have
get
a
the-
watch, so a smartwatch. It's like if I'm in the shower and someone calls me or I get an important message, I'll actually see it.
No, my old boss also said the same thing, where he was
Yeah.
like, and I think you also told me this before
Yeah.
when we were having a conversation, which was you constantly always have to be online. Like it's a never-ending cycle. Do you
Do you have
sleep all?
do you have
no.
special ringtones for like, let's say like you're sleeping and like something comes in that's important?
Yeah, like my watch will buzz, so I'll wake up. But
I would have to put the nuclear sirens. You know what I mean? Just to
Yeah,
make-
literally, I would
Yeah.
not wake up like it's like the
I try not to put myself in positions where I have to wake up at 3 a.m. because of something.
No, but what about the deals that you maybe are doing with investors that are in different time zones? Do you try and structure meetings where
when you travel.
Yeah, are
Yeah,
you-
you're in Miami. and
Yeah, like I would prefer to do most things over text.
Yeah.
deal closed.
So then that's sort of when they see it.
Yeah.
Otherwise, if it's a call, just work around it.
Yeah.
But I don't think I don't think of it too much. Like I don't really feel like burning out or anything. Like
Okay.
I can still find time to play tennis and like golf and meet friends. You know, I was getting a pilot license as well. It's like I had time to do that.
Yeah,
That's thick. That's
yeah,
thick.
he's flying and like checking the watch for deals.
Yeah.
Let me sign up this trade. Wait, we're going golfing and then flying, and then like for example, during the party, you had to sign up a trade which wasn't staged. So it's kind of like
Which
funny how that
which
goes.
plane model did you train with, or are you training with?
Technim.
Oh, very
Yeah.
very nice. Do you like to fly fast, or are you also a
I
conservative?
flew a
disciplined?
Pilatus, a PC-12 once. That
Oh,
was
okay.
that does like 400 knots, or
Yeah.
300 knots. It's like
Yeah, we have to do the next podcast like in the plane.
Yeah.
With like
If this whole finance stuff doesn't work out for the three of us, we just follow his coattails and become pilots or something.
what do you mean if it doesn't work out for us? Like we said it's gonna work out anyways. Like we could just go flying, you know. Might as well just like
Fair enough.
yeah.
So yeah, Amay will save us a lot on plane tickets.
yeah, maybe. Yeah. Where are you taking us? Cannes?
Yeah, we can go to Cannes. I mean, you go to Nice and it's a bit of a drive, but
Yeah, you can drive us.
Amsterdam, London, Cannes, and then we were can you fly to Miami? Is that too far?
yeah, the thing there is like if I lost the engine of the Atlantic, I don't know where I'd stick the plane.
Yeah, that's worse than the whole podcast that we're doing. So
Yeah, I guess if you're in an airline, you've got two engines. Like these are just like a single propeller. You just fly so high, you could just glide down like 8 hours.
Untimely demise.
yeah, no, but like thank you. I don't know. I don't have like more questions besides the airplane stuff. But do you have anything?
No, I
Still wanna-
think let's wrap this conversation up and then talk more in private when we're not being recorded. So you can be your full self, huh?
Anything you still want to say to any of the listeners? To the 5 people from the OG chat.
Yeah, just keep taking risks.
Oh, okay, very nice.
Yeah.
Yeah, I love that. Keep taking like, but not when you're flying, right? Only when you're.
Oh, I mean that is.
No, thank you so much for like
Yeah.
being here today.
No,
Like, it was
nice
super
chatting.
good. Yeah,
Absolutely.
appreciate you.
And for all the listeners, please look into his work if you're interested in Atomic Digital and funds in that space. Then Atomic Digital is one of the pinnacles of like proper quality when it comes to like institutional management of funds.
Yeah.
So definitely check out the fund if you care enough, or if Amay accepts you, then add him on LinkedIn.
Enough.
Then add him on LinkedIn, and then maybe if you're cool enough, then he'll add you back. You know.
Yeah, maybe. Well, you have to like mention some kind of airplane model.
Yeah. You have to mention your favorite airplane model in the little note that you get. If it's more than 130 characters, then he won't accept it.
Did you ever read books, by the way? Any books
Yeah,
you
yeah.
recommend?
Oh yeah.
What do you recommend? Podcasts, anything?
I like listening to Lex Friedman a lot.
Okay.
Yeah,
Yeah.
there's one like I think We Speak Billionaires or something. That's quite a nice one.
Okay.
Yeah.
Yeah.
It's also like a bit more like entrepreneurial and like
Yeah. My dad sends a few, so I sort of listen to whatever he sends.
Yeah.
Cool.
That's
Then
good advice.
maybe you can
Yeah.
put out like a paid list of things that they have to subscribe to every month, and then you give them a podcast for like 30 euros a month. You know.
Yeah.
Diary of a
Big good idea.
CEO.
Yeah.
But
All right.
Yeah.
And thank you so much. And then we'll see you guys in the next episode.
Absolutely.
This was Arnav, Amay, and Vincent. And peace out.
Yeah.
bye guys.
Yeah, that was good.
I know.
That was really good.
Everything is still recording.
Yeah.
Vincent, don't be yourself.